So now we'll go straight into our core learning for how to identify key levels of support and resistance, how to grade them, and essentially how we can ultimately make money from them. So first things first, a horizontal level is a level which directly corresponds with price, and it's a structure which price action can either break through or respect. They're generally aligned with key psychological numbers, or all-time highs and all-time lows, price extremities, and essentially they represent an equilibrium between buyers and sellers, where a level might have been protected by buyers, hence could represent a level of support, or could be defended by sellers and be a level of resistance. They're a lot more reliable, engaging sentiment than trend lines. Trend lines are a lot more subjective, as you might have found from your own experience. And of course, the more times price action has rejected a level, the stronger it subsequently is. And we'll show you exactly how we can make money from this a little bit later on, and you'll be amazed at the reward to risk profiles we generally get from such setups. And funnily enough, they're actually in range-bound markets, and we do get a lot of people who complain that they can't make money from range-bound markets, when actually we'll demonstrate to you that it's the easiest thing in the world to do in terms of trading effortlessly. But going back to this, horizontal levels generally do reflect the laws of supply and demand. If it's a level of resistance, for example, that's generally reflective of a level of supply, i.e. more sellers coming into the market when you've got something approaching a level of resistance. And if it's going down to a level of support, then we can reasonably say that, hey, if this level of support corresponds with a number which has been respected for quite some time, then more buyers will come into the market as they perceive it to be a point of value. And for those of you who are unfamiliar with the terms support and resistance when it comes to technical analysis, we can, define it like so. A horizontal level which price action has not been able to penetrate or breach going up or in an upward trend is generally referred as a level of resistance. Whereas on the flip side, a horizontal level price action is unable to penetrate or breach when falling is said to be a level of support. Experienced traders will always draw these levels on their charts because it essentially helps them get context. Where is the market potentially going? Where is it headed? Is it sandwiched between two levels? Is it moving sideways? Drawing levels in your charts, like we'll go through in a bit, will essentially enable you to preempt turning points, which you could potentially profit from. And if you have your levels drawn in already prior to the market getting to that level, then you could sit back and just watch price action come to your trap before trading it. You can see the move happening from a mile away. And it essentially gives us a really good heads up into preempting a move days and weeks sometimes before it actually happens. And that's great. I mean, some of the most experienced traders out there will plan their trade days and weeks in advance. We certainly do. We have levels which we've drawn in, and we're waiting for price action to come to our level patiently and diligently. And when it does come to our level, then we place the trade, but we don't place the trade at all beforehand, because that would be chasing the trade, and we do not want to do anything like that. And as you can imagine, the harder time frame we're looking at, if you consider the monthly, weekly, daily, and 4-hourly time frame, the higher the time frame, the stronger the level is going to be. Suffice it to say, a horizontal level on the weekly time frame is going to be a lot stronger than a horizontal level, say, on the hourly or 4-hourly time frame, because it's basically a reflection on the longer term people in the trades. And the longer term people in any trade is generally the people with more money, i.e. the institutions, the funds, the pension funds, the banks, dare I say. And as traders, we're not necessarily looking to move markets with our private investor trading account, but just simply go and follow its ebb and flow. We'll wait for the people to move the market, like the key banks and institutions. We'll just simply hop onto the trade when the market has made its move, essentially. We want to have probability in our favor rather than trying to predict tops and bottoms. That's what amateurs do, and that's when they lose a lot of money. And what you'll see us do in a bit, which is something we strongly recommend you do if you're drawing your levels on the chart, is to start off drawing your horizontal levels on the weekly time frame, and then you get down to the daily. You'll see they've already been written for you or drawn for you. You get down to the 4-hourly time frame, they're already there. So it's a great way of essentially gauging the technical levels over a myriad of time frames by only doing the work once. And we only really, as end-of-day traders, actually are concerned about the daily, weekly, and monthly time frame. We don't really want to worry about anything lower than that because it's just considered noise, really. Like certainly anything below the hourly is considered as noise. The 5-minute time frame, very wild and unpredictable. And certainly, you're going to like this for those of you who look at the news. Generally, the daily time frame is resistant to most news announcements, and we've been very fortunate with that. And even if we're the other side of the news, or the news goes against us, then at least we know that the most we can lose is 1%, whereas if the news goes in our favor and we happen to be right, then at least we know full well that we have got a minimum reward to risk profile of 3 to 1. Typically it's 5 to 1. So, you know, if we lose 1%. If we win, we gain 3% plus. So, of course, we don't know what the news is going to be in advance. All we can do is just sit back and enjoy the great theatre of life, knowing that the probabilities are stacked in our favor in addition to the reward. Okay, so why do horizontal levels matter so much? Well, they generally correspond with significant numbers, psychological numbers, round numbers, essentially where there's been perceived value to sell or buy by the prevailing buyers and sellers in the past. They also, in order for us to find predictability and order within the chaos of the Forex market, they're absolutely essential. I mean, don't forget that the currency markets are a random mess of chaos, whereby anything can happen at any time. And our job is, as a technical trader, is to simply find order in amongst the chaos. And we can do that by drawing levels. Gives us a much higher chance of getting high probability moves. So here we go. Here's a worked example for you. We've got a range-bound market here, and we absolutely love range-bound markets. As you can see here, the price action is ping-ponging between a level of support on the bottom side and a level of resistance on the top side. And this is essentially how we draw our levels. As simple as that. So we've got 3 touches on the level of resistance, and we've got 3 touches on the level of support. So probability will dictate that potentially what's going to happen next. What do you think is going to happen next? Do you think that probability dictates it's either going to break out and go long and breach this level, or do you think that the probability is slightly more stacked in favor of it going down to this horizontal level here? I would say going down. In fact, this is a kind of setup we'll take time and again, or in a heartbeat. We'll take it short. The more tests the level of support and resistance has, the stronger it makes it, and the better it is for us if we're looking to basically trade in the prevailing direction. And in order to define a level of resistance for you, I mean, it's reflective of the sellers overpowering the bulls and thus a potential opportunity for sell into this area of supply. And we'll kind of show you visually what we mean here, in addition to the level of support, which if it has more tests on it, it will not break, and that is reflective of the bulls seeing value to buy at this point, and thus overpowering the bears. Suffice it to say, if you're short, say for example on euro dollar, and you've got a key level of support, perhaps an all-time low, which has been tested several times in the past and respected several times in the past, it might be, you probably think to yourself it's going to be worth your while to take your profits before the level, rather than just simply hoping that it's going to break out in your favor and it's going to continue to go down, because what the level will do is essentially act as a safety net, and price action will be more likely to bounce off it, i.e. going against where your trade is heading, than to break. But in terms of where we find levels, they generally occur round numbers, psychological numbers, price extremities, all-time highs, all-time lows, 5-yearly highs, 5-yearly lows, 10-yearly highs, 10-yearly lows. You catch my drift. But we can further quantify levels of support and resistance by hard and soft levels and support and resistance. And we actually prefer the hard levels of support and resistance, because these are essentially levels which have not been broken in 10 months to a year. And you can see here that price action has been respecting these levels for over a year, or 10 months to a year, and essentially gives us much more confidence that if we get price action approaching their level, which hasn't been broken in over a year, that it's going to hold and we can just trade it short if is going long into the level. Whereas on the flip side, a soft level is one which has been tested and broken within the year, and it can be tested and broken on several occasions, but certainly because it has been tested a few times in the past, it could happen again. Suffices to say, if we look at this one here, we can see that price action has been nicely oscillated between these two levels here, resistance and support. However, it broke here, broke the level, came back, tested the level which had been broken before, but actually respected it before going down again. This is a soft level of support and resistance in play here. But we'll show you some real life examples, because of course it's all very good showing you perfectly drawn diagrams, but is that real life? Sure enough, the principles are there, but we'd rather show you on the charts now, today, live, happening at this very moment. So we'll just have an exercise for you now. Can you spot the levels? This is pound CAD on the daily, one of our all-time favorites. So a lot of people will look like a mess, but we can actually find order within the chaos here. There are two very strong levels of resistance and support. Can you see them? There we go. These are hard levels. As you can see, these levels have not broken in over 2 years, giving us unrivaled opportunity if we wanted to go for a very high reward to risk trade. And what we would typically do is wait for price action to come down to this level of support and buy. This will be considered as the best price for buyers. Pound against the Canadian has had in, well, over 2 years. So it would be a very good move in order to go long there on the level of support. So what we would do, in our opinion, is have a buy order on the level in anticipation of buyers coming into the market and perceiving value to buy. On the same token, with this hard level of resistance, which again hasn't been broken in 2 years, we can reasonably expect that based on probability, price action will come onto this level and respect the level. It did last November, it did last August, it did last July, without breaking the level. So what we would typically do is have a sell order on the level and a reasonable size stop, and we'll just simply put the orders on, walk away for quite some time. In fact, these orders will take you how long? 3 minutes to set up, and you can just simply go backpacking in Antarctica or on holiday, safe in the knowledge that you've risked 1% of your account for this trade, for this potential 15-to-1 reward to risk trade, and the worst that can happen is you lose 1%. If the worst that can happen and you get stopped out, but if it goes your way, you know full well that you've got a very good percentage return on your capital. We'll just highlight these levels here for you right now, or the points where it's interacted with this level of resistance here. It's interacted 5 times, so validating it as a very strong level of resistance, and the level of support, not quite so good, but still good enough. And this is an example of a range-bound trade which would look to capitalize off the back of, and it's got extremely handsome reward to risk. So we've got the hard levels, the unbroken ones in over a year. How about the soft levels? The ones which have broken before, but also been tested before as well as respected. And these represent buying and selling opportunities. Selling opportunities if it's this hard level of, this soft level of resistance up here, which has been respected before, but it's also been broken before. So whilst we might consider selling when it comes up to the soft level, it would not be as good for us as if we were to sell at this hard level of resistance here. The same token, we would look to potentially buy on this soft level of support here when price action is on its way down, but that would not be as good as a potential trend decision to go long when it comes down to this level which has been unbroken for over 2 years. This is where a considerable value point is in play, essentially. So here we go, we've got Aussie Swiss and a slightly different opportunity for you now on another cross-currency pair. We love the cross-currency pairs at Lazy Trader, by the way, if you haven't already noticed. So here we've got a little bit less straightforward to see, but if we draw in our hard level of resistance, there we go, right across the top here. right across the bottom. You can see the price extremity at the bottom. It's spiked down here, and it's respected this level for over a year, over 2 years in fact. And likewise with this hard level of resistance here. Suffice us to say, if price action comes up to test this level like so, it will represent a very decent selling opportunity for us, where we can have a nice tight stop. Again, this trading opportunity will take us, well, the trade will take us about 5 minutes to set up, and we can walk away for a very long time. Safe in the knowledge that worst case scenario, if we're wrong, we lose 1% of our trading account, but if we're right, we're set to gain a very decent, healthier return, and we'll demonstrate that to you visually in a minute. On the same token, this level of support here, if price action is on its way down, we've already got our order set up to go long with a stop loss below it, then we know full well our money is working for us, because the worst that can happen is we lose 1%. The best thing that can happen is that we gain a decent reward to risk from it, and there is a decent reward to risk profile here for sure. There we go. We can just exemplify the levels of resistance here and support. We'll look for the soft levels. Haven't got that many. This one's a soft level. This level has been tested and also broken a few times before. Same here as well. And again, these are okay levels in order to trade off, but nowhere near as good as the hard levels which we have. So looking at pound CAD on the charts in the present, we're still seeing it's adhering to its range and hasn't really done much for quite some time. But what I'll be inclined to do is simply just, and this is for people who really enjoy a low maintenance approach to trading, is simply put an order on this level of support here. In our opinion, this is a very good entry sign to go long for when price action comes down to this point, and the chances are it's going to ricochet off it and go straight to the middle again, because based on probability, it's done it before several times, twice before, and if it goes all the way up to the top, the likelihood is very high that it's just going to ricochet off and go back down into the middle. I mean, this range is present over the course of the past 2 years, over 2 years. So if we did want to buy it from the bottom of the range, say if we're risking like 67 pips, or even let's say 50 pips. So if we did decide to get into the trade, like so, our entry will be on the level here, and our stop loss will be here, giving it enough room to breathe just in case we do get a spike. So we've got a 52 pip difference between our entry and our stop loss. Our stop loss is nicely above this level, which has been respected here and rejected here. So if our entry is just below it, we're risking 52 pips, and we're looking to pursue, we're looking to target 3/4 of the way down this range, looking to pursue 918 pips profit. Then we've got a reward to risk of 918 divided by 52, which is a reward to risk of 17.6 to 1, which is a phenomenal gain. A phenomenal gain. But guess what? These setups don't occur the whole time, and we need to be patient for them. And that's where lots of people fall down in trading. They just want the instant gratification, unfortunately. Like, for example, last November, we had this set up on pound CAD again, and very same logic, actually. We looked to sell here because we saw this level hasn't been broken in quite some time. So what we did was we simply had an order to sell on the level, just below it, just so we were filled, and we had, there's a 50 pip difference to our entry and our stop loss, like so, and our target was down here, just shy of it, so we had 900 divided by 50, we had an 18 to 1 reward to risk trade again, and we just find it very hard to believe that when people say the markets aren't trending, we can't trade. We just find it very hard to accept the fact that some people can't see how easy it is to potentially make some very good percentage gain just trading in a way where they're simply selling the top of the range and buying the bottom. If you wanted to buy at the bottom of the range and you wanted a high expectancy outcome but a lower reward, there's absolutely nothing wrong with just taking it halfway up to the range, so to the midpoint. And on the flip side, if you're looking to potentially just trade it short of the top of the range, and you wanted a high expectancy outcome, there's nothing wrong with you just going and taking it halfway down to the bottom of the range, and you can have a low profit or lower profit, higher expectancy trade. Whereas if you wanted that higher reward but accept a lower probability for that higher reward, then you take it all the way to the other side of the range. There's trade-offs to each way of doing things, really. Are you somebody who would rather have like a higher probability but a lower reward, or are you somebody who'd rather have a higher reward but a lower probability? The decision is yours. That's definitely something for you to mull over. However, once you come to the answer of that, it really will kind of affect your trading plan in a positive way, because a lot of people just, they look for the trading opportunity, and it's one thing waiting to get into the trade, but it's a whole different kettle of fish as to how they're going to manage and actually get out of it. But even if you're unaware of this currency doing such a thing in November, or you didn't necessarily have this on your radar, don't worry, this setup is still valid. In fact, this looks better than ever, actually, because this range is established over an even longer period of time now, and quite frankly, it's as valid for as long as it still keeps it inside this range. And once we hurtle down to this level, round at 153.01, we could potentially see a decent long move afterwards, and that's exactly what we're waiting for, because in our opinion, price is going to come down to here and then bounce off it and come at least halfway up to the top of the range. And likewise, when it gets to the top, until proven otherwise, until we get a close above this level of resistance, we're good to go south, good to go down. And that's exactly what we're waiting for. Whether it goes up or goes down in this range, we've still got opportunity in it, and that's a fantastic thing about it. But funnily enough, it's not all about pound CAD. There's other currencies taking on this form. Let's take the Aussie dollar, for example. We're in a long-term upward trend. We've been hesitating for about a year and a half. And at the moment, we're hurtling towards, we look at the daily, we've just come down from the weekly. We're just hurtling towards this all-time high here, which is a very protracted sell level. It's correlated to the 1.100 level, and to us it represents a decent sell level. As what has Aussie dollar been doing for the past year and a half? It's been range bound, and this level will have memory. So we could potentially see an opportunity whereby we sell at this level. It's a big round number. It hasn't breached this level ever. It's the highest it's ever been, the Aussie dollar versus the dollar. So we'll wait with bated breath to see if there's any opportunity there. When the time is right, that is. But did you notice how we just started off on the weekly time frame and we churned down to the daily? And this is really quite handy to do, because not only are you getting more of a kind of bird's eye view of the currencies and the context of them, but you can also just look for levels of support and resistance far easier than if you're just on the daily, because sometimes when you're on the daily, it's quite hard to see a lot at once. It just depends how much fits on your chart, really. It's a very similar story with pound New Zealand. If we have a look here, we've got a very strong level of resistance here, which hasn't been broken since April 2011, and we've got a very decent level of support here. So we're in a very long-term protracted range here. So what do you think the logic would be if and when price action came down to this level like so? One would be tempted to almost buy. And if it came up to this level here, one would be tempted to almost sell, purely because the probability has it that price action is likely to bounce off it and ricochet back up into the range. And even if we're wrong, we've lost 1% or however much we've risked, hopefully not more than 1% of our account, in pursuit of a high reward to risk trade. For example, if we had an order on the level, like so, to go long, say, and we're risking, say, 100 pips in order to make, say, 1,755. So if you're wrong, you've lost 1% in pursuit of 17%. However, if you're right, even half right, you've made a very decent return. You've made, wow, 8.5%, which is an amount not to be sniffed at. So this is why reward to risk is very handy for us. If we go for high reward to risk, it means that we can almost be wrong more times than we're right and still make a profit. That's the beautiful thing about reward to risk, for our style of armchair trading, if you like. And as you can tell, regardless of whether you put like a order to buy on this level here or an order to sell on this level here, the fact of the matter is where you see price action is at the moment, it's quite far away. However, if you just simply place these orders here and walk away, go traveling, go on holiday, take a course somewhere, or anything, whatever your heart's desire, you could find quite happily that if you're triggered or not. If you're triggered, then great, probability is in your side, and you're in the very high reward to risk trade. If you're not triggered, then at least you could say that you're in the opportunity flow. So you can see how this style of trading really is very popular amongst our clients indeed, because you could just simply set your orders and forget about them. Suffice it to say, looking for price extremities like so, like a level of resistance which hasn't been broken for over a year, like a hard level of resistance which hasn't been broken for over a year, or a hard level of support which hasn't been broken for over a year. These are very efficient price points in order to sell and buy respectively. And this is why we can just simply place our orders and walk away. And same for the previous examples which we gave you, like for pound CAD, we could just simply set our order up to go long of this level of support as and when it gets there and walk away, and conversely set our order up to go short of this level of resistance and walk away. And it doesn't take us long to do this. All we need to do really is, even if we look at the charts once a week for 10 minutes or even 20 minutes, we can see these hard levels, sight them from a mile away, place our orders and walk away. We don't even have to look at our charts every day. We can just simply say, well, if I'm in the trade, I'll be triggered into the trade, then at least I could potentially get a 5, 10, 15, 20 to 1 reward to risk trade. If it doesn't work out, I lose 1%, but hey, it's a good reward to risk anyway, so you've got to be in it to win it, as the expression goes. And if you're not triggered into it, then that's just too bad. And a lot of people, unfortunately, they see currency trading as a get-rich-quick scheme, whereby more trades equals more money, where from our experience, it certainly doesn't. And unfortunately, it's a sad truism that a lot of people who try and trade the financial markets fail purely because they don't bother to get coaching or see how they can essentially improve their game.